Why is America buried under a mountain of debt that China doesn't even want back? On one hand, America's economy thrives on borrowing, while on the other, why is China rejecting this debt? And what is the secret that could shake the world of debt? So come, let's uncover this shocking truth. America's economy runs on debt, and one of its biggest lenders is none other than China. Today, China holds around $860 billion in U.S. debt, making it the second largest foreign holder after Japan. But this isn't some simple case of lending and borrowing. This is a high-stakes economic dance that has been going on for decades. The relationship between the two countries is deeply complex, with both nations tied together through mutual dependence. China doesn't buy American debt to be generous. It does so to keep its own economic engine running. China's economy is heavily export-driven, and to keep those exports attractive to buyers, especially in the U.S., it needs its currency, the yuan, to stay weaker than the dollar. To achieve this, China actively buys U.S. dollars and invests them in treasury bonds, which helps keep the dollar strong and the yuan low. This strategy allows Chinese goods to remain competitively priced in international markets, especially in the U.S., ensuring China's factories keep operating and millions of workers stay employed. On the flip side, America benefits from low-cost Chinese imports, which help keep inflation in check and store shelves full. Every time the U.S. imports more than it exports, China accumulates dollars, which it doesn't just sit on. Instead, it cycles those dollars back into the American economy through government debt. This provides China with steady, safe returns while helping America fund its government and various programs. In the past, some analysts feared that China could weaponize this by suddenly dumping its U.S. debt, triggering a financial meltdown. But that fear is mostly overblown. If China ever tried that, it would end up hurting itself more than the U.S. A rapid sell-off would strengthen the yuan, making Chinese products more expensive globally. That would shrink export demand, cause job losses, and possibly trigger a recession in China itself. So yes, while it sounds threatening in theory, it's more like holding a weapon you can't afford to fire. Even when China did sell off a significant chunk of U.S. debt in 2015, around $180 billion, the markets barely reacted. Why? Because U.S. treasuries are still seen as one of the safest investments in the world. China's share is just a small fraction in the grand scheme of things, roughly 2.6%. That means, despite the headlines and fears, America isn't dancing on a tightrope held by China. Instead, both countries are locked in a balancing act. China needs to lend to keep its economic cycle alive, and the U.S. borrows to keep money flowing and goods affordable.